Hey, good morning. All right, I think I know what needs to be done. All right, is this better? All right, any change? Still bad? Okay. I know the camera's down. I don't know what would be causing the feedback. Static. Yeah. Huh. What would that be? All right, then it is related to this microphone. Let me check. Hmm. So I've unplugged everything I think I can unplug and replug back in. Any more changes, I think the only thing left would be to do a full reboot. My mic is not there. Yeah, you know, the truth of it too is I haven't been happy with the sound lately anyways, so maybe it's just failing. Maybe that's all you get out of a $200 mic, is it only lasts a year. So maybe it's time for Daddy to go shopping. Yeah, I thought maybe it's just on too loud. So I'll turn down the decibels. Yeah, maybe it's just too sensitive. In sooth, I know not why I am so sad. Is it all right? All right, so anyways, welcome to Forex.Today. It is a Monday, approximately 8 o'clock in the morning, February 22nd, 2021. Thank you for being here. This is a YouTube community of 17,500 foreign exchange traders. We want to talk Forex, technical analysis, fundamental analysis, trader psychology, and everything else in between. Let's go. So let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Oh, there's the camera. Very nice, very nice. Oh, it looks crooked. I can't... Is it crooked? Anyway, it might be crooked. Anyways, hey, good morning to see you. So, what are we going to do today? Yeah, let's do some charts. We can do Euro, Aussie, CAD, Yen, Pound, Kiwi, that kind of thing. Just let me know what you'd like me to cover. I'd like to ask you to take notes. If you're learning, if you're here to learn, that's great. Take notes, ask good questions. I'll do my best to answer your questions if I can. There are often a few people watching and asking questions. So you ask a question by typing, and then I might give you a 20-minute response. In that 20 minutes, a few other people might actually ask a question too. So if I don't get to you, then guess what? I'm doing these webinars every single day. So if I can't get to your question today, I apologize, but maybe I can address it tomorrow. And if it's a burning question, an itchy, scratchy, burning question, you'll show up tomorrow. So maybe you should subscribe and click the little bell so that you get alerted when I hit the stream button. And when I go, boom, stream, and it goes pa-chang. Okay? Oh, Ananda watched a documentary on the stock exchange flash crash. Cool. That was an interesting day. Cool. So anyways, thank you for being here. Hey, you're a currency trader. You're going to need a Forex broker. I like Trader's Way. Why don't you visit tradersway.com and just check it out. You're like, hey, if Wayne's using it, what's this all about? Okay, check it out. Download a demo account. Play some trades. Ultimately, they're going to have competitiveness, right? They're going to have competitive spreads. They're going to have decent customer service. They're going to offer you different platforms. They're going to have fast execution speed. They're going to have narrow swaps, big spreads, all these things that you like. But ultimately, you need to choose a broker that you trust. Okay? So ways of developing that is look at their business model of supporting our community. Education first. Maybe they want their traders to succeed. I don't know. I think that's really cool. What else? Swiss National Bank debacle took out the largest brokers in the world. They went out of business because apparently they were trading against their clients. That one day was proof that Trader's Way actually executes your trade into the interbanking system. So you're like, oh, well, that's like, it's proof. It's evidence. So if you know what I'm talking about, you're like, okay, that's good. That's a good thing. So, but ultimately, you need to decide, and you need to make an informed decision. So check them out, tradersway.com. Oh, that coffee is so good. That coffee is so good. And I'd like to thank LZTV Entertainment for allowing me to use their royalty-free instrumental metal music compilation volume 1. It's the only thing on YouTube that doesn't get banned, I think. And I'd like to thank the subscriber who sent me an email to say that I need to stop rapping 90s rap, and which is totally cool. And he sent me the link to awesome music. I appreciate that. That's cool. I need 10 more of these coffees, please. Oh my God, that tastes so good. All right, so what do we got in the world today? Well, what I'm hoping for is dollar weakness. Look at this roller coaster going on here. But dollar down is a good thing, so I'm happy with that. Yen down, that's a good thing. I'm happy with that. Swissy way down. This is interesting because we haven't had that for a while. And I don't know if I should believe it or not. Okay. Oh, here says, don't forget you can fund your Trader's Way account with crypto. Yeah. Oh, for sure. Okay. But isn't that cool? So typically you have yen down, dollar down, Swissy down. It seems to me like the last 2 years, Swissy's been doing the opposite of what I would normally think. And then we were planning on, I think it was a swing trading group on Thursday night. I think we were doing like CAD Swissy or something. Or maybe it was dollar Swissy. It must have been dollar Swissy. And I think it was Raymond, actually. Wasn't it Ray? And I'm like, yeah, I know exactly what you're saying. The technical analysis is spot on. Absolutely fantastic. I don't believe it. Because it had to do with the Swiss franc. And I'm like, I know what you're saying, but I don't trust it yet. So now Swiss franc's doing exactly what I want, but I don't. Even though it's doing what I want it to do, I still don't trust it. So it has to earn my loyalty and respect again. Okay? Cool. So what else is going on? Aussie up, pound up, Kiwi up. Okay? This is all risk on. CAD in between, and again, there might have been a swing trading group conversation. If so, I'll tap into that just in case. But we were talking about CAD is interesting because there's nothing but bullishness, especially because of energy. But because of that, it may not continue, which is kind of weird, right? Mostly because price is going to be pushed up based on fear of adverse effects on supply, and then when you get there, and it's always never as bad as it could be, and then there's no need, and so anyways, it reprices again when sort of the fear dissipates. So there's a thing where it can be overbought. So anyways, so CAD's down. To me, like I guess what I'm trying to say in English is CAD is down when everything else is up, and I'm okay with that because I think on the long run it will continue to appreciate. Right now it's overappreciated, so it's sort of right sizing, if you will. Does that make sense? So it's down today, but like don't worry about it. You buy it. You'll get a chance to buy it, which is actually a good thing. Okay. Euro Swissy, actually well, first of all, Euro Swissy is only interesting to talk about if you're trying to find the right value for Swissy directly, like this index. But, Asmi says I should, I guess, look at the chart is the question, right? But Asmi, if you look at it, Euro is quite weak and Swiss franc is extremely weak. So you wouldn't want to look at that pair. Stephen said, you read my book this weekend? Cool. It only took me a year to write it. So I'm glad you knocked it out in 3 days. But you learned a lot. Sweet. Cool. I can't imagine much of it would be outdated. The numbers would be outdated, right? But I think everything else would still be spot on, even though we're approaching, 12, 13 years? I don't know. But there's still like universal truths in the market, and all of that is there, right? So like I'm sure I talk about things like oil going up and CAD going up, and you're like, oh yeah, that makes sense. So I used to do, around that time, I used to do a few different speeches. I'd go on the regular speaking tour around the world, around the United States. And one of the speeches I used to do a lot was describing chaos theory and the butterfly effect, right, on the markets. So what was it? It was chaos theory, and what was the other one? It wasn't behavioral finance. chaos theory and can't remember. Anyway, so all those things are still true. So I'm glad you liked it, is another way of saying it. Cool. So yeah, so going back to ASME, euro is fairly weak, but you see that it is recovering. And Swiss franc is very weak. So even if you get some euro Swiss franc up, there's probably something better you should have been doing, right? Oh, Steve says he didn't know oil around the world was priced in dollars. Well, the interesting thing is the United States put Saddam Hussein in power during the Iraq-Iran war, and then Saddam got filthy stinking rich, got his power, and then he started like, he didn't want to be the U.S. puppet anymore, right? So anyways, he caused problems. And then we said, well, you need to send in UN inspectors. And they did all that for years and years and years and years. And then one day Saddam says, we want to sell Iraqi oil in euro. Boom. That was the end of that. We attacked. A decade of playing games, but one sort of hint on selling oil for a euro, and the tanks started rolling in. But yeah, the history of oil is fascinating. I don't want to talk about it today, but read anything by Daniel Yergin. And you're going to find out that it's 1,000 pages per book. Well, if you want to know about oil and history, guess what? There's a lot of detail in history. Okay. Yeah, Nanda says, don't mess with the dollar. I used to describe it as the United States being like a giant drug dealer standing on the corner, okay? And you piss off the drug dealer and he breaks your legs. Robin says, how about Gaddafi, right? Gaddafi selling for gold. So, his 30-year reign of terror ended that day, probably, right? So don't get caught in the conspiracy theories and all that. Just read the book. It's very interesting. How all of this was done. All right. So like Aussie, for example, is probably something that you could be looking at. Now, let's take a look at like Aussie Swiss franc or Aussie dollar. I guess we'll do Aussie dollar just because that would have been more likely of what we would have talked a lot about. So most of last week, right? I think last week and the week before, we had things like lots of central banking data coming out of Australia, lots of news, lots of data points. Some of it quite disappointing, but nonetheless important, right? And one of the things I was doing is trying to get you to think or even trade ahead. Lots of Aussie news. I even brought up the website. Look, this is what you should be reading. Oh, look, this is coming up later in the week. This is, And now that we've had sort of this time period pass, right, like this area here was all last week, I wonder if it influenced you even a little bit. Okay? I wonder, I tried to help you change. I think it's the most difficult part of all of this. Our natural instincts don't seem to be helpful. Otherwise, most people would be reasonably profitable when they begin trading Forex. And for some reason, well, we know most people are not even reasonably profitable, not even profitable. Okay? So I wonder, like, we must go through a metamorphosis as a species if we want to emerge as a Forex butterfly, so to speak. Somehow we make this gig work. And so I influence them, like, you should be doing this. You should change the way you're thinking. You should look at this from a different point of view, right? And ultimately, I know, it's frustrating, but I know 95% of it is ignored by 95% of the people. And so anyway, so like all of last week, Aussie, and now we're up here. And we know the cliche is now that it's up here, now people are interested in buying it, trading it, selling it, doing whatever. But they were not interested here. And to me, this was the market loading the weapon. Okay? So sometimes I find it frustrating because I want you, right? I want you to make a change, right? Look in the mirror and make a change. And I empathize because I know how difficult it is. I had to go through a lot of suffering. And oddly, that's a key part of Buddhism, right? Couple of things, right? The suffering makes you stronger, right? Without suffering, you can't have any, pleasure or something. But also this idea, another tenet of Buddhism is impermanence, right? And like every trend we trade is impermanent. It will end, right? Which is very interesting. So maybe we should all just become Buddhists and trade like, Buddhist hedge fund managers. What do you guys think about that? Right? Wouldn't that be great? We have prayer wheels and they're like, right, hey, Bubba Wayne, what's the trade plan for next week? And I spin the wheel. Sell the dollar. Sell the dollar. Spin the wheel again. Don't sell the dollar. Yeah. You got to wake up the Forex gods first, right? Yeah. So anyways, so I hope you, I hope you find the strength you need to make that sort of mental or spiritual breakthrough, because we do have to look and behave quite differently than we naturally would. Otherwise most of us would be successful right off the bat because it's instinctive, but we know it's not instinctive, right? When I quit my job as a venture capitalist, my wife bought me a license plate cover. I don't remember. I was driving some convertible back then. But anyways, and it said this. That's what she brought me. I have it somewhere. It's pretty cool. Which is really interesting. Just for her to do that for me in of itself is very interesting. If you knew us, right? So very interesting. So it was cool of her. Yeah. Michael says too much coffee. I need more coffee. I'm very tired. All right. So anyways, change everything so that you can deal with the even more difficult things in life, like life. No, that doesn't sound like fun either. All right. So let's move into here. Cav says, are we still expect seasonality profit taking on Aussie? I don't even know what you're talking about. What do you mean seasonality profit taking on Aussie? I don't know what you're talking about. I'm pretty sure you're supposed to be buying the heck out of Aussie dollar if you're doing seasonality play. So I'm not sure what you're talking about. Before the Fed meeting. Well, I'm not sure what you're talking about. You're supposed if you're doing seasonality play, you're supposed to be loading the boat on Aussie dollar. Oh, dollar strength before the Fed. Well, no, I think you're confusing a few things. Dollar strength, yes, can occur in this period for sure. But the seasonality play, I guess, is sort of backwards. I'm trying to get the language here. What you mean? So what is supposed to happen between now and the Fed meeting? But like, which Fed meeting are you talking about? I think you're talking about June. Okay. So between this period and the June Fed meeting, which is the 16th of June, I'm sure you know, right? You're supposed to be selling US dollar. So, so when you're like, can we still expect seasonality profit taking on Aussie? So what that means is selling Aussie. So, so I don't know, maybe you're typing it quickly and I'm misunderstanding, but it feels like what you're saying is off a little bit, and I'm not sure, Calv, right? Before the March meaning. So first of all, you don't think Aussie dollar. When we're talking about that kind of stuff, what we're talking about is US dollar. Now, what you're saying is against the Aussie dollar, which may or may not be true, okay, but you wouldn't describe it the way you did. So, right, I'm not knocking you down. I'm just saying that what you said was confusing. So I think you're saying, is Aussie dollar still supposed to be down? But no. But you should also know that you're supposed to be buying Aussie dollar this time of the year. So you should be long Aussie Japanese yen, for example. Right, like this one, right? Like this is just in the last couple of weeks. So you might be confusing a couple of things is all I'm trying to say. Okay? So the way you described it to me was very confusing. So one of us is confused, probably both, right? So yeah, be careful. Be careful. Also, if you're talking now about dollar, US dollar, there's a couple of things that we've been discussing. Let's say this is an average. So I'm not looking at this chart, by the way. I'm just drawing this in the middle of a chart. So let's say this is middle. And let's say this is early, this is late. Okay? Average, early, late. And what we've been saying is in the bell curve, let's say. So let's say there's a bell curve. Okay, fat tails kind of stuff. That's supposed to be the middle. Sorry about that. Okay, but this year, even though it would be not typical, dare I say atypical, it would be typical to be average, but nothing is typically average. It's just average is average. And looking at the fundamentals that are in play now, mostly based on Fed policy, the economy reset and everything, potential stimulus on the way, we're much more likely to be in this tail. Okay? So you have to put all this into perspective. So that would push commodity prices up. Aussie, Kiwi, CAD, for example, should all be rallying. We also know if the dollar is strong in this period and we're trying to decide, is it going to weaken early? Is it going to weaken average? Or is it going to weaken late? We're going to say it's going to weaken early, right? So you would start Aussie yen long and then tiptoe, certainly by February, start tiptoeing into Aussie US dollar. Okay. 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 Well, but see, Calvin, so the one that I've picked out specifically, okay, so now you have to add all of that. This is only dollar. Then you throw it down against Aussie, and I think that would be your worst choice for selling Aussie dollar. But that's not the seasonality. There's two different plays going on. The Aussie side is supposed to be weak. All right. So the Aussie side is supposed to be strong. So now let's go back to isolating dollar. What I said was euro dollar down. Okay? Because euro is 40% of everything, it's going to be most affected, not affected just because, like, Aussie is going to be affected by China. It's going to be affected by commodity prices and all that kind of stuff. So I don't think I ever said sell Aussie dollar. It'd be more like take your profit at the top of the year and then buy a dip, right? And it'd be one of the first ones you'd be buying it. So it's more like, yeah. So I guess the long answer to your question, if you're asking about selling Aussie dollar, no. Whatever. Whatever. I don't even know what the question is, but just the idea of like selling Aussie dollar, no. Okay. Now, let's say you want to, because now you're asking my opinion, but it could be your opinion to sell Aussie dollar, which is fine, right? Which is fine. So now you would have to say, well, what market conditions would create the sell? Do we have those market conditions? And then the next part is on smaller time frames. Have the market conditions changed because of what you saw in the higher time frames? And if so, then you could do it. Okay. So I'm not saying you're wrong. You asked me my opinion, and so I would say no. But remember, everything is impermanent, like I just discussed, right? So you could say, okay. Now, buying this, right, is not that complicated. Okay, like, let's just switch to this. So, like, on swing trading bullish bias, for example, okay, was here. So you could have bought it Wednesday or Thursday, but like, okay. And remember, we opened out a position. And then we, with bad news, and then the news came back down, but we also knew there was news, I think Monday and Thursday, right? I think there was the news. So we knew, whatever, let's say we don't know. Still, if you're a bull, this is a buy. Like, I don't know. And my whole point last week was, prepare on the Aussie, prepare on the Aussie, prepare on the Aussie. So whatever. So if you're a bull, I mean, it's pretty clear you had like 8 hours, even a second chance in there, right? Like on a smaller time frame, let's say. Right? I mean, there's a lot going on here if you're a bull. Now, the next part is, what if you're day trading it? So you day trade bullishly. And, yeah. Okay. So I think this part here was the weekly buy. And then there's the daily buy, and then there's another daily buy. So like on Friday, another clear buying opportunity, right? All you had to do was be a bull on a daily trade. And you're a bull on a daily trade on top of a bounce on a bullish weekly trade. You see, there's a swing trade and then 2 or 3 days of day trades. You right? So, as long as you're day trading, and as long as you're swing trading, these are pretty straightforward. So again, this is a very, very straightforward swing trade. You had 2 or 3 days to prepare for. And then once you get down there, you want to drop into smaller time frames, right? And so there's a buy on the weekly trade, and then what? Higher high and comes back. I mean, most likely if you're day trading, you would have bought it here and put your stop. And it started great. It was a horrible ending, but then it worked its way back up. The next day, there's another one. Same thing. They're all Asia fade front runs. But I suppose if you're logging in London Open, you're on the wrong side of these trades. That's why I prefer swing trading as my primary strategy. Right? Right? Okay. That's primary. Okay. So, yeah, what do you do now? You know, yeah. It seems to me like, do I want to be front running tomorrow already? Well, I don't know. So, I mean, now we're into something quite late just to be going. So you want to always check where you are. Okay. And here's the ultimate thing. Okay, and this is what I was leading up to. Ultimately, last week, I mean, look, not complicated, right? So now looking at it from this point of view, what does this all tell us? What does this bottom tell us? What does all of this tell us? Typically, you would stop trading up here. Okay? So to Calv, if you were going to be a bear, I wouldn't do it. Okay? But I'm a macro trend trader, so I'm not going to counter trend. So what I think the safe thing to be doing, because a bull should be like scaling out. If not, they already got out, right? But let's just say what's likely to happen over the next few days, or more like how would I design it? And that would be like, this is where a double top would be born. It doesn't have to. We can't predict it will. But very often when these types of formations occur, they occur in zones like this. Okay? And this is the monthly, right? R2. It's very, very important. It's a very important price. Okay? And so to say it differently, if you were a bull on Aussie dollar, okay, on the first day of February, you had a perfect price in the first hour of the first day. Okay? And back then, your target zone was this gray area. So you had February 1, 2, 3, 4, 5, 6, 7, 8, 9. So anyways, what I'm trying to say is on the first hour of the first day, you had a buy. And you're like, well, Wayne, how did I know to buy that? Well, you were already a bull. So you already knew. There wasn't a decision-making process. There's a great price here. Now, maybe you waited and all that kind of stuff. Well, then you're certainly in here. Okay, so either way. And based on that, you had a 22-day run into this price area. And the reason this price is here is it gives you an exit. Okay? I named this at a Pete's Coffee, by the way. I named this the pivot profit zone. It's not an entry. That's why talking with Calv, I'm like, no, I wouldn't sell it. You could, and you might, and it wouldn't be wrong. But me, I don't like counter trend trading. I can do it, but I don't like it. And you could do it and it might be fine. because if it came down, it could come down a while. But again, I don't really want that. So what I do know is this is a buy area, faux show, and this is by design, by definition, is the exit. So if Calv wanted to sell it, I would say, well, why don't you wait for evidence that people do exit? Because then if they do exit, they're not going to fight you on your sell. So at least for some period of time, you could do it. Okay. Now Calv says, I'm not a bear. I want to enter at a cheaper price and go long for the year. Great. Then what would create that process? Well, people have to get out if you want to buy it for cheaper. Okay. Okay. And if you want to be in it in the beginning of the year, then you have a stop here at break even, another stop here at break even, and a stop here at break even. Okay. And now we open out of position. What does that set up? A counter trend on the weekly. Okay. We're OOP on a weekly. So maybe this sets up the counter trend, which means we come up, we get close to 80, and then the whole thing collapses for a bit. And now between, let's say, we'll call this February 25th, and somewhere between that and we'll call it March 15th. Somewhere in that period, you will get a new higher low. And if you set that up, then you would make the determination, do you hold it for 3 days, 3 months, or 3 years? Okay. So think about it this way, Calv. You can anticipate where bulls exit and bears enter. And not only do you anticipate it, you welcome it. Okay. Okay. Yeah. Okay. And so what you're trying to set up is, where would bulls exit? Here. Where would bulls buy? Here. So now you have a plan that looks like this. You enter it just like any other swing trade, any other day trade, any other scalp. It doesn't matter. The major decision is, how long do you hold it? When do you exit? Are you going to exit in June or in December would be one question. Down to 77? Yeah, sure. Oh, Gary took it at 77.77? Right on. Very good. Was that your plan, Gary, at the swing trading meeting? Freed says, yeah, it'd be good pull back for the trend. Well, that's the thing, right? Like, that's how these things happen. Okay. So now do you notice we've been talking about reflation almost a year now. Not quite, right? 10 months, 8 months, 8 months at least. And have you guys been watching the yield on the 30-year? Just amazing. We've been on that for a while. 30-year yield. Okay, check that out, huh? Very cool. Okay, and now look at it. Isn't that amazing? Oh, my pleasure, Cal. What does this mean, guys? Do you know? I've explained it a few times, but I don't know if you know. Like when I show this, I don't know if you get it. Like, what does it mean? Like, okay, yeah, okay, I went from 1.84 to 2.14. Like, okay, so what does that mean? Do you guys know? Michael says, holding a trade for 6 months, should I be concerned about swap? Well, many things have very little swap, so it wouldn't be a big deal. Commodities do. Okay. So what does this mean? All right. How do you drive yield down? Let's not talk about up. Okay, but how do you drive it down? Okay, the opposite here. How do you drive it down? How do you get yield to fall? Type in a question mark if you don't know. I find it very helpful because then I can let you know. And if everybody knows, I don't need to cover these things. So I look at this, I'm like, oh my God, and I can think of like 9 things, right? And I'm like, oh my God, just look at that. Okay. Also, I have explained it. So if I need to explain it again, it's important that you let me know. It's not like I give you quizzes and find out, oh my God, the mean grade was a C minus. They don't get it. I'm going to have to reteach it, right? All right, the way you lower the yield is to buy bonds. The more bonds you buy, the lower the yield goes. Why do people buy bonds? Because they feel uncertain. They feel risk averse. They feel, in some cases, even afraid. Why would you say, take my money, I'm going to lend you money for a long period of time, but I'm not going to charge you very much? Why would you agree to a deal like that? Because you're afraid, like you're getting some other return. In this case, you feel pretty good your money won't go away. Now, you're not going to earn anything, but maybe your money not going away is, in of itself, the thing you're looking for. As Famobik says, for safety. So you're willing to lend the U.S. government a certain amount of money for a long period of time, and you're not asking very much interest for your loan, but you're like, well, as long as it's in dollars, I feel good. Okay, whatever. So you're not a confident trader. In fact, you almost look like you're almost just stuffing it into a bank account. Okay. All right. So if you're stuffing money into a 30-year bond or a 10-year bond, for example, okay, then you're not very confident. Well, now if you're taking that money back and investing it somewhere else, then you are confident again, right? So in March, when I told you that you can't save your way into prosperity, that now was the day, today was the day to start buying the stock market, for example. I said, create a list of 10 stocks that you've always wanted to buy, but you couldn't afford. Now's the time. Make your list. I said that several weeks early. And then we got down to literally a particular day in March. Now's the day. Okay. And I said I was locking up some deals with the family money on that period. And then a couple of weeks later or a month later, then we had Jay Powell confirm everything. And I'm like, that's the day I'm going to sell the dollar now for 5 years. Do you guys remember all of that? The reason I'm saying it is I'm going to use it as an example, right? So back on that day, I remember the 10-year T-note yield was less than 0.5%. Okay, 10-year yield was less than 0.5. It's now 1.34. It's doubled, and doubled again. So what was happening at the end of March when, what actually created the yield on the 10-year T-note to fall all the way down to 0.5%? Was the world feeling good, or was the world feeling afraid of investing? Yeah, the global economy had crashed. The global economy had crashed. Borders were shut. Restaurants were shut. It was the end of the world as we knew it. Okay? So around that March period, I say, okay, you need to buy back in. You cannot save your way to prosperity. Most people at that point, or let's say the global market, had bought U.S. Treasuries to the point where they almost paid nothing. I'll give you an example of how amazing a yield on the 10-year T-note at being 0.5 is. Back in 2006, maybe 2007, I did a presentation explaining using Newtonian physics, so it sounds really smart, why the yield on the 10-year T-note cannot go below 2%. I actually did that. I did a presentation using Newtonian physics. I mean, if that doesn't impress the girls, right? Oh my gosh. Using Newtonian physics, I explained why the 10-year T-note could not drop below 2%. It was impossible. Well, look at it now. Even now it's way below 2%. So imagine how bad it was and how low the yields were. And then Jay Powell said, we will not go negative. Okay? All right. Now think of it. If buying bonds drives the yield down, what happens to price if everyone is buying bonds? What happens to a market when everybody's buying? And I mean everybody. It's the only way to drive a 10-year T-note down to 0.5. Yeah, the price goes up if everyone's buying. So you can look at it as yields falling, but what if you looked at it as prices rising? Okay? Now think about that. And then you get to a point where you believe it literally won't go higher. Like I made that determination because the Fed told me. They said interest rates will not go negative, which means they will not contribute to driving interest rates lower. So therefore, then that is as low as they will go. So I threw that down. Okay. Now, what's a different way of trading it? If you think prices are ridiculously high, and very much likely not able to go higher. What's another type of trade you could do? Well, you could sell. You could be a bear. Okay? Now, one way to be a bear is then you ask, well, who is buying? Well, we know everybody. Okay, everybody is buying, but that would also include foreigners. Foreigners in other countries, foreigners in other economies, foreign banks. Let's say the Bank of India, for example, buying U.S. treasuries. Okay? To lower their own currency. Remember, they can convert their currency to dollar, and then they buy the 10-year T-note, which means they've weakened the rupee, and now they have U.S. treasuries on their balance sheet. They bought dollar. Now, see where I'm going here? So for these treasuries yields to drop to 0.5, foreigners had to buy the dollar so that they can then, with the dollar, buy treasuries. So now if we get to a point in time in April of 2020, if yields will not fall further, then prices will not go higher. Therefore, right, the bond market, or in this case, treasury market, would fall, which means to get it to rise, the dollar was purchased by central banks and other investors around the world, so the dollar would start to weaken. Okay? Do you guys remember having, I didn't explain it this way, I explained it a different way, but do you see how it fits in back then, back into April? We are actually bond traders. Okay? If you work at a bank, you work in the fixed income department as a Forex trader. Okay? Fixed income, commodities, currencies are all in the same department. Okay? So now imagine the dollar is also now at a high. See, bond prices were at high. At the same time, the US dollar prices were high. So you could borrow dollars, and then in 5 years, let's say you have a loan that you did back in April, you took a big loan. Now you have $1 million loan, but you also have $1 million, right? And over time you pay for the $1 million, but every time you make a payment, your dollar now is worth less than when you borrowed it. So it's almost like, every time you make a payment, $1 is worth 99 cents. Then you make another payment a month later, and it's worth 98 cents, that dollar in your old term, right? And then in 5 years, you're paying back your loan, and now $1 is only like 82 cents, and you're paying back. You're making money paying it. You borrowed powerful dollars, and you're paying it back with cheap, powerless dollars, right? There's ways to play this. So, what does it mean now? Fast forwarding, interest rates are rising. How do you get interest rates to rise like this? And by the way, this is not even a month, guys. It's not even a month, and interest rates are skyrocketing in the United States. Skyrocketing like crazy, out of control. I hope you know this. What does it mean? Nobody in their right mind wants to be owning a bond that pays you nothing. Now, you say, well, it pays 2.14, but not the one you bought, 8 months ago. It still pays you 0.5, right? So, or whatever it was. So they're getting out of that, and they're deploying their capital and investing it somewhere else. Where? The stock market. Where? The commodity market. Where? Crypto, right? Just other places, anywhere but bonds. The bond market is crashing right in front of you. Well, what's the consequence of that in the currency market? Do you think a professional Forex trader is watching the yield skyrocket. And now, by the way, this is there's a yield curve to this. So the yield curve is steepening. Remember, people were worried that it was inverted. They were worried that it was flat. Now it's not flat. Now it's steepening very quickly. What does it mean for the currency market? And again, if you don't know, type in a question mark. I did answer it about 3 minutes ago. I said when yield was at 0.5, that means prices were sky high, which means the value of the dollar was super high, because before you can buy a treasury, you have to buy the dollar if you're a foreigner. So foreigners were buying dollars to buy treasuries, and therefore prices for the treasuries would go up. And since the demand for the dollar is the same as the demand for the treasury, because you have to demand the dollar first, then demand the treasury with your dollar, therefore dollar was priced high, treasuries were priced high, and yields were low. So reverse that whole thing. Yields are skyrocketing. The bond market is collapsing in front of your eyes. How will that impact the US dollar? Well, it's the opposite. The dollar would get weak. Money is going to flow back to the original bond holders. Who were they? Indonesians, Vietnamese, Russians, Saudis, right? One guy in Hungary. Right? It's going back to where it came from. Dollar should be weakening. I'm looking at this and I see the dollar weakening. Oh, by the way, I prepared you for this months ago. Okay. Cool. Okay. I want you, I don't know where you are in your, Forex education, but if you've been around for a while, and you're trying to find like what you should be focusing on as far as your personal growth as a trader, then one challenge I would give to you is to say, teach yourself how to be a bond trader. Because what we are bond traders. So when I tell you the Reserve Bank of India, the Central Bank of India is devaluing the rupee so that they're competitive globally, what does that mean? Well, gold prices are going to go up, and the dollar's going to go up. And of course, the rupee will weaken because that's why they're doing it. Well, how do they weaken the rupee? They have to increase supply globally, aka sell the rupee, but you don't just sell rupee, you trade rupee. Rupee for what? Rupee for US dollar, and then with your US dollar, you put bonds in the vault, and you put bars of gold in the vault. And the cool thing is the balance sheet hasn't changed. Right? So like here's a balance sheet. Balance sheet. Okay? Here's a balance sheet. Assets, liabilities, and whatever. We'll call that capital. Bank capital. Okay? We'll call that bank capital. And this should balance. That's why they came up with a clever neat name called a balance sheet. So on the asset side, you have cash, you have gold, and you have bonds. Okay? Cool. So let's say if cash goes down by $1 billion and gold goes up by 500 million, and bonds go up by 500 million. What's happened to your balance sheet? Does it still balance? Yeah, cash went down, gold went up, bonds went up. So by and large, your assets haven't changed at all, right? You see that? So that's what the Central Bank of India did, except by doing this, the US dollar went up and the value of the rupee went down because this cash went into the interbanking system, and now there's $1 billion more of rupee in the interbanking system. And that wouldn't have much effect, but it would shift supply, right? So right now, the bond market is crashing as these rates are going up. And when these rates are going up, the dollar should be weakening. So isn't that interesting? So I don't know, in year 3, year 4, year 5 of your development as a currency trader, you should challenge yourself to look at the Forex market as a bond market. Because what we're trying to do is track the flow of money. So business cycles are important, right? And the central bank's response to business cycles. Okay? So when the Central Bank of India is lowering the value of their currency, most likely they're pushing up the value of the dollar. Okay? It's very interesting. Okay? So this is the dollar falling as these rates go up. Okay? The other thing that happens in times like this is commodities would go up. And really, consumption of all assets would go up. Okay? But I essentially was selling the 10-year T-note since March, right? Which means I'm betting interest rates will go up. And they've gone up almost 200%. So cool. Very nice. Yay me. Yay me! Cool. Track the flow of money or human capital. Let me think about that. The flow of human capital. The flow of human capital, I think, would be a long run aggregate issue. Because most of what we are looking at, these things are fixed. But yeah, I don't think so. I think it's just literally the flow of capital, not human capital. Okay. I guess what I'm trying to say is I can move $1 million to another country faster than I can move 1 million people to another country. Right? I can add more capital per worker to improve GDP, but it's hard to add more labor. Right? What's easier to do? What's easier to do? Double the productivity of a worker by 100% or double the population? Either way, you get the same output, right? What do you guys think is easier to do? Well, especially in an economy where the capital per worker is low, doubling their productivity would say, well, stop digging with a shovel. Let me get you, a bobcat. You guys know what a bobcat is? Images. Literally going to give me that. Oh, here we go. There we go. All right. I can double the productivity of a worker using shovels. So let's say 10 people with shovels. Well, I can give one person a bobcat and he could do more than the 10 workers with shovels. So the productivity of that one worker is unbelievable, right? It went up 1,000%. Okay? So it's easier to double the amount of capital to increase output. And the question is, the flow of human capital. I could just spend money and buy a bobcat. It's pretty easy, right? You're like, I can make the money or I can borrow the money. And I can just buy one of these things. And now I'm very productive at digging in the dirt versus a guy with a shovel and a pickaxe, maybe, right? So that's one reason poor countries are poor. And I'm going to explore this in one of my lectures coming up. This idea that if you can't borrow the money, you're screwed. You're just you and your shovel. And now you're like, well, I need excess money so I can buy one of these things. Well, how are you going to make more money? Think about it, guys. You want to buy one of these things, but there's no banks. No one's going to loan you the money. So here you are, you're stuck with your shovel. So how are you going to make more money, save that money, and then buy this with cash? How are you going to do it? You have to work more, right? It's a denominator issue. So like, for example, like for you economists, you're probably thinking, productivity is a function of capital and labor, in this case, a workforce, right? But you want productivity per worker, which is a function of capital over the workforce, right? And then you're going to rewrite that. Y over N is equal to the function of K over N 1. And then, of course, 1 over 1 over times everything doesn't matter. So you're going to simplify everything. And you're going to say, right, your production function is Y over N is equal to capital over the workforce. Okay. So if you can't increase your capital, you're stuck with your N or your K. K won't, so you make K fixed, right? You're going to have to increase N. Now, N can be simplified to L. And then you can say, well, if that worker is going to need to make more money to save more money, capital is fixed, so they're stuck with their shovel. How do you increase labor? They're going to have to work more. Instead of 8-hour days, 12-hour days, and weekends, and that extra time they'll have to save, and eventually that savings will be turned into what? Savings will turn into investment, and the investment will buy the bobcat, which increases capital. Does that make sense? Sorry for doing calculus. Sorry, didn't mean to ruin your morning. Brinsley's like, you still need a guy with a shovel. Well, anywhere there's a bobcat, there's always a dude leaning on a shovel, right? It's amazing. Maybe it's just Georgia. Okay. Cool. Is that right? In South Africa? Yeah, there's always a guy rich enough to pay someone else to lean on the shovel for them, right? There's a story in Canada, and it goes where a guy walks out in the morning and he sees a government worker truck out front on the opposite side of his home. And these workers get out and they finish their coffee. So pretty soon it's 10:30 in the morning, and the government workers are going to have to actually do something. So one of them digs a hole while the other one stands there and watches, leaning on a shovel. Okay. Then what? Then they go back, have a coffee break. And then the other worker fills the hole with dirt while the other one stands there leaning on his shovel, watching them. But they do this 2 or 3 or 4 times. And finally, the homeowner walks across the street and he's like, "Hey, what's up, fellas? What are you guys doing? Like, why are you guys digging a hole and taking coffee breaks and then filling the hole back up?" And they're like, "Oh, well, the guy that plants the tree is sick today." Well, welcome to Canada, eh? Wayne, do I use stochastic? Sure, for sure. Stochastic. Well, let's pick one we haven't done yet. Yeah, Aussie Kiwi. We'll get on this one. This one's probably nasty. All right, let's add a Stokes. So template, standard. Cool. So we're not doing Miggity MacD, so we'll kill her. Like, wait, I thought MacD was a dude. All right. So here's our Stiggity Stokes. Okay. So here's what Stokes is doing. Let's do the math. The statistics of stochastics. Man, that'd be a good book, huh? The statistics of stochastics. Okay, what we're looking at is lower lows and higher highs. That's all it's looking at. And then you have to say, well, how far back do you want to look? Do you want to look all the way back to here? You can do that. You're just changing the parameters. But ultimately, stochastics is just looking at, is it making lower lows or higher highs relative to the previous candles? Okay? So right around here, we get something different. So let's say we'll make it, if you're looking back one candle, it's not made a lower low, but it has made a higher high. Then the next one is, it has not made a lower low, but it has made a higher high. And then on this one, it has not made a higher high, but it has made a lower low. So you don't want your charts to look like this, or I guess it'd be like, You probably have seen indicators look like this, right? Yeah, probably useless is what you found out. So what you want to do is say, well, based on a certain amount of candles, which you can define any way you want in these settings, are we making lower lows relative to this? Well, let's say, do we make a lower low here? No. Did we make a lower low here? No. Did we make a lower low here? No. Did we make a lower low here? Right? We're still measuring this. Now, every time you add a candle, you're dropping a candle. Okay? As well. Okay? And what you want to know, the reason you're using it, is are we making a series of higher highs and higher lows, or lower highs and lower lows? Okay? And these candles are only looking back. Like this one, I custom set my stochastics because I want to know what price is doing. So I have them very sensitive. Okay? And typically you'd use it on a smaller time frame like this, right? So now I'm trying to say, if I'm a bull, when are decent opportunities to buy? Because I'm using it to say, I already know I'm a bull, and I want to buy low, right? So when is low? And a stochastics is really good for that, because not only is it telling you when is it low, which is actually not the information you want. What you want is you want to, okay, you're a bull. You want to buy low. Okay, you want to buy low, but you also want to buy low, low, but when it's starting to turn up, because you want it to go up in value. You don't want to buy it because it's doing this. You don't want, low is not enough. Low, but turning back up, okay? So anyways, to go through here, to go back through this stuff, let me just clear it, okay? We actually want to look at this part. Okay, you're buying low when it's starting to rise. Okay? Okay? That's what you're looking for. It was falling, but now it's not. Buy. If you're bullish and you believe it's an uptrend. It was falling, but it isn't anymore. Buy it if you're a bull and you believe this is an uptrend. It was falling. We can see that here. But now it's not falling. Okay? Okay. Now, you might notice if you watch this enough, you're going to call some of these false positives. And that's true because all it's telling you is the last few candles are not making lower lows. Okay, let's go back into your translation versus what it's actually doing. Okay, what this is saying here, is at this point in time, we know it's no longer making lower lows. You see that? 1, 2, 3, 4, 5 candles in a row. No lower low. Okay? Here it was lower low, lower low. Okay? Not lower low, not lower low, not lower low, lower low. So you can see this kind of roll over, down, 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 down. And then all this is telling you is it's no longer making lower lows. Not that it won't, because remember, it's not predicting anything. It's just telling you what the math is. The math is doing the math. Okay? And therefore, a movement up is saying it's no longer making lower lows and it's trying to make higher highs, or at least higher lows, okay? And it's trying to make higher highs. So it's trying to turn up, is all it's telling you. It's not predicting that it will. It's only telling you relative to your settings, how many candles you're looking back, is whether it is making lower lows or if it's trying to make higher lows and higher highs. So you can see here, suddenly it started making lower lows again. Well, that's what brought it back down. So again, it's not predictive. So you must be predictive. And therefore, to make better decisions, you're going to have to use this tool in conjunction with other decisions. 1, are you bullish? Okay? Okay, so that's your bias. But here's the other thing. Stochastics being oversold and rising is only relevant under certain circumstances. So if you ever paid money for a course where some guru comes out And he's like, oh, stochastics is magic. Buy low, sell high, buy low, sell high, buy low, sell high, buy low, sell high. See, you're a millionaire. People used to do this, by the way. Have you guys run into something like that where a guru has just told you, oh, use your MACD or use your stochastics or use your RSI or use some other awesome, amazing indicator? Has anyone come across such a strategy? Jamrock says yes. Anybody else? It's pretty old school. Okay. Well, that was going to be my next question. Did it work? Okay. And no, of course not. So they're missing a piece, by the way. Okay, they're missing a piece. Because it probably looks like that going back, but here's what you need. First of all, you need to have your bias. Otherwise, you won't know how to read this. Because look at, if you sold up here because it was overbought, you lost money every time. You're like, but I sold the stochastics. It's way overbought. That's not how to use it. That's not how to use it. Why is it overbought this whole time? Or most of this time? Why is it overbought most of this time? Because everybody's buying it. Why would you sell something everybody's buying? Like, even the logic is just crazy if you think about it. It's not predicting anything. It's just telling you everybody's buying it, and up here there's less and less buyers. That's all it's telling you. Okay? But you have to start with your bias. Otherwise, you won't know this tool, how to use the tool properly. The second thing is it only tells you when it's no longer making lower lows and it is making higher highs. So it tells you right here, no more lower lows. So that might be relevant information to you if you're already a bull. Okay? But there's also something missing, and that's price action. I would submit to you for your review the idea of, if you're going to use an oscillator, that you must know your bias and you must know price action, because what you're doing is you're asking stochastics to tell you when it's no longer making lower lows, but in fact making higher highs and higher lows, which means with price action, you would be buying something that is no longer making lower lows, but instead making higher lows and higher highs off of support. Because now, here's what you're doing. You're buying because you're a bull, and you're buying at support when price, so I can consider this a price indicator, not a market indicator, a price indicator, when price is starting to rise. How about that? You're buying because you're a bull. You're buying at support when price is starting to rise after a bounce at support. Do you think that works? Do you think that idiot guru should have known something like that? So let's draw it. Okay, imagine now you were trading something like this. Are you a bull or a bear? A bull. Cool. So we need some, right? So now that you're biased, you want to buy a dip, you want to buy low. Okay, so we got all of that. At support, so price action helps you predict support. And now you need the oscillator to be oversold and then rise up, because we know what the math is doing is it was down, 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 then it stabilized, and now we're making candles that are not making lower lows and are making higher highs. By definition, by statistical analysis, the math, the algorithms, that's actually what's happening. And so now, using your stochastic oscillator, which is now me answering the question that somebody asked me 20 minutes ago, you buy in that kind of situation. Yeah, Ted, they're all basically the same with different tweaks. Like, they're similar, but they're different. So I can't say they're the same. Okay, but like, what's the difference between PCE and CPI? Well, the math is different. The news reports CPI, the Fed uses PCE, but they're both equal to a basket of goods and services. And you create the basket of goods and services to identify inflation. So I could say, well, they're both the same. They're both baskets of goods and services that are designed to measure inflation in the economy. But they're also different. Now, who wants to go for super bonus points? Who wants like what if there was an exam to see how much you know your shiat? Okay? Who wants to take a fundamentals pop quiz? I'll give you a question right now. I want to make sure you're ready. Okay? This is a pop quiz, super extra bonus points. Okay, you ready? Give me one different basket of goods and services that measures levels of inflation. Okay? Again, you can't say PCE, you can't say CPI. Give me one more basket of goods and services that measures prices and growth. Because the prices and growth are kind of interchangeable, right? Anyways. Give me one more. PPI, no. It's only like one part of an equation, so no. No, not cheese, taxes, no. Jamrock says GDP. Well, that gives you a number, but you need to do something to GDP to make it act like a basket of goods and services. COT, no. You're okay. You're close on GDP. It's not quite right. That's not the answer. You're only partially right. You have to do something to the GDP to make it act. Real GDP is better. It's still not the right answer. But now GDP is interesting because it's everything in the economy. It's the ultimate basket of goods and services. But it just gives you a number. Oh, Craig is so close now. I'm going to give it to Craig. The GDP deflator. Oh, snap. So yeah, I'll give it to Craig. That's pretty close. That's pretty close. Right? It's really output measured in dollars over a period of time. But yeah, so you have to Google GDP deflator. How many people here have never heard of the GDP deflator? Anybody? I think many people probably have heard it and just didn't know what it was. You've never heard of it? It'll come up. Right. Let's ask Google. GDP deflator. I think it. Anyways. What is GDP deflator? Is a price index that measures the gross domestic product by adjusting the impact of changes in prices of goods and services to the true value of goods and services produced locally in the economy. All right, you see, like it does what CPI and PCE are doing, but now you're doing it for everything, basically, right? Okay, but you see now when they do that? Okay, formula is pretty easy. I'm sure they give you a formula here too. How is it calculated? Okay, it's pretty easy. Dividing nominal by real and then multiplying by 100. Okay, because what's the difference between nominal and real? Thank you, Adam. We can take a look at that. We'll have to get Elon to pump it up again. Yeah, inflation. And so what is CPI and PCE trying to measure? Inflation and prices. So now, instead of using, like, for example, CPI and PCE are different baskets of goods and services, and they change at different intervals, and they both have their certain strengths and weaknesses. But using a GDP deflator to measure, instead of like, see, PCE and CPI, they're used to measure inflation. But one of the issues is the baskets are different and they're updated differently, and they don't take into account things like quality and what else? Substitutes, and I'm sure there's a college lecture out there on these things. So the deflator is just saying, well, what about everything? What about the price of everything produced in the economy? Well, that's what GDP is. And then we're like, well, do you use nominal or do you use real? So you're like, well, what's the difference? Well, the difference is price inflation. So if you then compare real with nominal, you will get an inflation number. Well, what's the difference? It's the inflation. Well, why don't we use GDP, the deflator then, right? Because now it's all prices on everything. Right? And I kind of like it. I like that. So we'll get into that in the macroeconomics, I'm sure. I don't know when I do it. Probably not in the next few lectures. But anyways, just to throw that out there, since since the question was asked, I challenged you. Pretty cool, though, right? So now you'll see it. You'll see it, right? You're going to see it in the newspaper somewhere. And now you'll know. Yo, slick blue. Bitcoin's crashing. Bitcoin's crashing. Is that right, eh? It's crashing? Oh, for sure. Looks like it came down to the 200 EMA on the hourly in a buy zone. And then people bought it. Yup. Let me update this. Yup. Cool. Cool. Yeah, I think people would have bought it at 50 because they said so yesterday or Friday. Right. I don't think you have to be a rocket surgeon to buy it at 50. But, all right. Wouldn't call it crashing either. All right. Pound yen, huh? Yeah, this is more interesting to me. Okay. So I see profit taking in the tea leaves. Okay. One thing I want to add to this is go, actually, it might be in the new chart. Let's do swing trading bullish bias. And no, it's not. All right, let me update this. So I go to indicators, okay, bias pivots, and I'm going to turn this to give me the conservative target as well as the aggressive target. Now I need to save this. So I'm going to go template, save template, and it's called swing trading bullish bias. So I'm going to save that. And it's going to say replace it. Yes. All right. Okay. So we're probably pretty close to an R1 at that 83.50. Okay. Let's do this one. And once again, it's only aggressive. So I'm going to change this. Template, swing trading bullish bias, boom. And now it's added the conservative target as well as the aggressive. So we'll drop into an hourly chart. And I'm sure if you were trading this, you already did it on Sunday. And your target this week is going to be up in here. Your concern, of course, is that you're trapped in mid-range. Okay, so it's a timing issue. But a buy in here on Sunday, pretty straightforward. And if it rolls over, then you're going to have to adjust. Wait, it's not right. There we go. Let's take a look at the... Oh, well, first of all, let me change. Template, swing trading, bullish bias. And there's the conservative target. There's the aggressive target. Okay. Where's support? Okay, right in here. Cool. Let's do this one, kitty cad. Let's update the template, swing trading bullish bias, gives us our targets. And we're not even close. Okay. So we're in our buy zone. And we got to be careful. Let's do this one to this one. Okay. Obviously, you don't want to be lower. Yeah, we'll do it that way. You don't want to be lower than that. So you got to keep it above the 83. Cool. Nice. Good. Good. Okay. Okay. Now, what is the importance of what's happening now? What's the importance of this? What's the importance of if the yen pairs take a little bit of a break here on their on their rise? Yen pairs rising. What if we take a breather on that? Is it a big deal? Does one bad week, let's say the rest of this week is yen strength. Is that a big deal? It's only 1 week. This has been going up for a long time. Okay. Should there be concern, or is it just a glitch in the matrix for a little bit? Yeah, it's needed. Oh, but there we go. Craig's on top of what I'm hinting towards. Because it's nearly March, I would be extremely concerned that if this falls today, it'll fall for the rest of the week. And if it falls for the rest of the week, it's going to fall for 3 or 4 weeks. Yeah. And I'll give you hints if you watch videos from 2 weeks ago. 2 weeks ago, I said, it's going to happen. What was the other thing? I said, well, most likely the yen will get strong and the dollar will get weak. So in January, we had sort of dollar would be strong and yen would be weak. Now I'm saying yen gets strong and dollar gets weak. They're reversing. We talked about it as a rotation out of this and into that. Dollar gets strong because of taxation. Yen gets strong because of taxation. Okay? Or it's some other thing that just happens to coincide. It doesn't even matter what it is. As long as you think you know and you do the right thing, then what's the difference? So it would be concerning to me for about 3 weeks. Okay? So this would be a repatriation, Japanese yen repatriation, because the Japanese people, Japanese businesses, they need the cash to pay taxes. Pretty straightforward. Okay? If it was May and we saw something like this, I would treat it completely different. I wouldn't think of that even for a millisecond. It wouldn't even occur to me. And if it happened 2 weeks ago, I think we did have some yen strength for a little bit, didn't we? And I said, nah, too early. No, we didn't. We didn't even have it ever. All right, so check it out. Since November, okay, let's go all the way back to November. Yen weakness, yen weakness, yen weakness, yen weakness, yen weakness. Has anyone here heard me say in the last 6 months that March Japanese yen will be strong? Now I'll put this down as JP. In this case, pound versus yen down. So yen will be strong, so this pound goes down. Has anyone heard me say that? I just want to make sure I'm not making it up on the fly. We're talking about 3 weeks from now. I would expect. Now, it doesn't have to happen, but this is what I expect. Okay? How far? I don't know. Is it going to be strong for 3 weeks? Maybe. A month? Maybe. Less than that? Maybe. I don't know. Okay? Gil says lumber should already be going up. I believe it's already very, very high. Gil. Not because of low interest rates. Okay. But an increase of consumption. Like, how did I describe this to you guys in October, I think? I did... okay, we had something like GDP equals C plus I plus G, let's just say. Okay, so what we're talking about here, oops, we're talking about G going up. Therefore, consumption should go up, right? And when consumption goes up across the board, everything from gold to lumber to GameStop, because it's free money from the government, so of course you're going to spend it. Okay. So does everybody spend every penny? You could thread that together if you want, Othmar. I'm not suggesting that, but I see the logic, and I don't think it's wrong. Does everybody spend every penny? Or can you do something else when government spending goes up? The government gives you money. Does everybody spend every penny, or can you do something else with the money you got for free? Yeah, so what is it? What is I? Save it. Okay. So what's the formula for savings? Okay. Well, let's look at what we can do. Government spending, and I mean, like, to be clear, I mean, let's say the government gives you a stimulus check. That's what I'm talking about. So government spending goes up by $1 billion. Okay. And then, okay, minus consumption of 900 million. So this is 1B. The government gives 1 billion, of which 900 million is spent. So G minus C equals what? Savings. They printed $1 billion, gave it to the people. The people spent 900 million. So therefore, 100 million was saved. You get the logic? So you can say G, the change in government spending minus the change in consumption equals how much there was a change in savings. So savings has gone up. G went up, right? C gone up, and now savings has gone up. Okay? So now you know savings. Okay? And so savings you put into a bank. What does the bank do with it? Loans it out in mortgages and small business loans. Okay? Asset-backed securities. What's another way of describing investing into small business loans where you buy a new truck for your business, or you buy a new machine for your business, or you build a new building for your business, or you lend it to a business owner who then buys a house? What's another way to describe this kind of activity? Okay. It's interesting, right? Have you made these connections? It all adds up. It all adds up. It's a giant balance sheet. Pretty interesting, huh? Capital expenditures, that wouldn't be the full of it, because when you download GDP and you're looking at it includes the general public buying homes. That's an investment as well. Okay. So you could say private real estate plus commercial real estate plus CapEx plus whatever. Like, yeah, but all of that. So, you know what? I'm spent. I need coffee. I'm out of coffee. I'm just spent. So I'll tell you what. I will see you guys tomorrow. Tomorrow's a Tuesday. Lovely day, Tuesday. So thank you for being part of our community of 17,532 foreign exchange traders. Thank you for your good questions. I hope you liked the answers. If you did, would you please click the like button? I will see you tomorrow if you subscribe. And there's a whole bunch of links in the description below the video, things to like training courses, live groups, my book, videos, to tradersway.com, all that kind of stuff. So Emmanuel says, thank you, Wayne. I'm starting to become a profitable trader. Very, very cool. Very cool. So now you have bragging rights. You can impress very good-looking people because now you know what the GDP deflator is. So I think that's a good day, huh? That's a pretty good day. So peace on earth. May the pips be with you. May your profits be above average. I hope you love this thing called Forex. I thank you for allowing me to geek out on economics. I mean, I'm an economist, right? So, and I do apologize for the calculus this morning. I know many people probably flipped out. Flipped out. No, he's solving for the lowest common denominator. Yeah. Cool. I'll see you tomorrow, guys.